Hey, traders. Welcome, traders. Here is Awesome Forex as usual, Awesome Forex as normal. And this is our homepage. And the one who is talking is Mr. Awesome himself. Yeah, the man of the match, the master himself. So I'm here again as usual to present those who call the free sessions. We have those who call the free sessions that everyone can have access through YouTube. Anyone can access it through YouTube. So I'm doing this for the people, and I'm doing this just to guide the traders in their trading journey. So at the very beginning, usually I like to direct you through those major areas. We have those who call the major links or major buttons. So we have got a first button here for LITEFOREX broker. Then we have a button for TICKMILL. These two brokers are the most recommended for those traders who are searching for brokers with good trading conditions. And then we have got other buttons there. A button for it is now Facebook. A button for a Facebook page. Then we have this for Instagram. And then the last one is for Telegram channel. So those are our major sites. Those are our major links where we share our basic information. So welcome again to Awesome Forex, and today it is another weekend and it's the time for sharing things, and blessing have come. Usually when I'm blessed, I share things. I share free things, free contents whenever I'm blessed. So I have blessed again, so I'm going to share something today. And our today's content is from what to call the MOST. Now our today's content is from what we call the most powerful candlestick patterns. The most powerful candlestick patterns. So in the previous sessions, for those traders who follow our Swahili course, now we have our Swahili course. Now for those who follow our Swahili course, we have a content on those who call the candlestick patterns, and also we have a content in English. Then we have a single content in English, which is also describing the issues on candle. It describes the morphology and psychology of candle. So if you have been following those sessions, today it is like continuation of those sessions about the candlesticks. And today we are going to discuss in detail, and we are going more specific to those what to call the specifically powerful, the most or the major candlestick patterns. Why we call them as the major candlestick patterns? Because these are the most occurring patterns. These are the frequently occurring, I can say, and also these are easily understood. You can describe them easily. That's why we call them the most powerful. We have many candlestick patterns, but today we are going to discuss those. We call them as the powerful or the selected one. The selected ones, whereby we have those candlestick patterns into three groups. As usual, as I described before in the previous sessions, I said we have three groups of candlestick patterns, whereby the first group is what we call the mono. We have those who call the mono candlestick patterns. In a mono candlestick pattern, it is when we have just a single candle, and that candle gives you certain information about the direction of the market. So that's what we call the mono. It doesn't mean that you have just a single candle in a price chart. No, you have many candles in a price chart, but your description is based on a single candle. That's what we call the mono candlestick pattern. Then we have the second one, which is known as the die. Now we have this, we call it as a die candlestick pattern. In a die candlestick pattern is when you have many candles in a price chart, but your concentration is on two candles. You concentrate just on two candles. That's what we call the die candlestick pattern. And the last one, the third one, is what we call the tri candlestick pattern. The tri candlestick pattern is when you have many candles in a price chart, but your concentration is on three candles. It's just on three candles in a price chart. So that's what we call the tri candlestick pattern. So now today I'm going to dig deeper on those things, even though I described in past lessons, but today I'm going to dig deeper to show how the things will apply in the market and how you can play with them and what is the psychology behind them. I will be touching also the things about psychology of those candles. So this is our today's discussion, and we are going to dig them deeper. So now mainly here we're going to look the three major groups as I have described those groups there. We will look on three major groups of the candlestick patterns. So from those three groups, we will find many patterns inside them. In the first group, maybe the mono candlestick pattern, we will find that we have several candles. So let's start with the mono now. Let's start with the mono. Let us start with the mono now. I will write down I write it in a very short form, a mono, but you have to understand that this is the mono candlestick pattern. So I write it just as mono. So now the mono now, we will start one pattern after another in a mono. We will start one pattern after another in a mono. So now the first pattern in a mono, we have this candle here. In a mono candlestick pattern, we have this candle here. Now this is a pin bar. Now this comes from now I will be writing some descriptions here. Now this comes from what we call the pin bars. Now we have those who call the pin bars. Now this is the category of a category of pin bars. Now those pin bars, they are of two categories. Now pin bars are of two categories. We have the bullish pin bar, and then we have the bearish pin bar. So we can have those categories. Now we have the bullish. Now I write some things there. We have a bullish, and then we have a bearish pin bar, but all of them now, they are the pin bars. Now a bullish pin bar and a bearish pin bar. Now what we see here is what we call a bullish pin bar. What we see here is what we call a bullish pin bar. Now a bullish pin bar usually shows a bullish momentum. That's why we call it as a bullish pin bar. It is known as a bullish pin bar because it shows a bullish momentum. It shows a bullish momentum. Yes, it shows a bullish momentum now. It shows a bullish momentum, a bullish momentum. It shows a bullish momentum. Things are not going now. Yeah. A bullish momentum. Things were not right there. So it shows a bullish momentum. Now morphologically, in order to understand this, you have to understand the morphology. In order to be clear with this pattern, you have to understand the morphology, and then you will understand now what is expected to be next in a price chart. So you'll find that it has got a small head there at the top. In a bullish pin bar, this is commonly known as a hammer now. It has got a small head, or a small we call it a small body, which is upper, or which is above, and it is above a long tail. We have got a long tail below there. So now having this candle in a price chart, now this will indicate turning of price from the bearish momentum to bullish momentum. So now why it gives those information, now how it gives those informations. Now mainly once you describe the psychology of this, you will find that this candle opened here. It opened here. Now we have this area here. It is where it opened. So after opening, now it may push up a little bit or anything else. I think I described those movements in a previous session. But now after opening, in general now, sellers came in. Now sellers come in, they pushed in, they pushed it lower the price. Now push down. Now they pushed the price up to this area. They pushed the price up to this area down there. So now before the candle has closed, buyers came in. Now before the candle has closed, buyers came in. They pushed it up, and they pushed it above the opening price. Now you will find that they pushed above the opening price, and finally price closed above. Now it closed above to a certain area there. So after closing, now we will find that now what information we get from this candle is buyers, they are still in control. Now buyers are still in control. That's why we call it as a bullish. It shows a bullish momentum. So now in order to trade this, in order to take trade, once you have this, now we have to see the next candle. We have to wait for the next candle. Don't take trade immediately after you see this, you see a hammer. You have to wait for the next candle, whereby a next candle, if it keeps on going up, it will be a good trade. Now it will be a good trade. Or sometimes it may move little bit lower, up to 50% of this. Now sometimes it may go up to 50% of this tail. So after closing to the area of 50%, sometimes you may take a trade. So you may wait. Don't take a trade immediately after this has closed. You have to wait for the next candle either to cross above this one or to move just a little bit lower, up to about 50% after closing. So you may take a trade. So that's how you are going to trade a hammer. That's how you are going to trade a pin bar, a bullish pin bar. So we are through with the bullish pin bar, and where now this occurs. Now where this occurs and where you will take a trade when you see this. Now we must have, I described the things in the previous session. We must have a long-term uptrend, now an uptrend. Then in this long-term uptrend, it will occur a short-term downtrend. Now when this pin bar is formed at this area, when a pin bar is formed at this area, now this will be a good indicator of reversing and continuing with the uptrend. Now it's where we are going to take a trade when we see a pin bar, when it is at a short-term downtrend of a long-term uptrend. Now a long-term is now a trend is upward. So now it was just a short-term pullback. Now it was a short-term pullback. Then we have a pin bar in a pullback area. After having this pin bar or hammer, now we can take a bullish trade. That's how we are going to trade this. Now I'm through with the bullish pin bar. As I've said, we have two types of pin bars. We have a bullish and a bearish. So now let's move to the next type of pin bar, a bearish pin bar. Now let's move to the second bearish pin bar. Now a bearish pin bar is something like this. This is a bearish pin bar. Sometimes they call it as a shooting star. Now sometimes they call it as a shooting star. A bearish pin bar is known, sometimes they call it as a shooting star. So now a shooting star has got just the inverse informations from what we have described from the hammer. It has got an inverse information, whereby it has an opening price. Now this opens higher and it closes lower. Now this is because this is bearish. Now it opens higher and it closes lower. It is different from the bullish, where it opened the lower and closed the higher. So now if it opens higher, now sellers come in, they push the price down. After pushing this price down, before crossing maybe, or in any way around, buyers came in, pushed it up. Now buyers came in, pushed it up. They pushed up to a certain level, and before it has closed, now sellers came in again. Now sellers came in again powerfully, pushed it down, push it down, push down, push down, until it closes below the opening price. Now it closed below the opening price. So at the beginning, now remember, at the beginning it opens here. Now buyers may come pushing up, in any way may push it up, or sellers may come push it little bit down, then buyers come in up, and then sellers come in again and close just below the opening price. So the key information here is until this candle closes, when it was closing, sellers, they were in control. Now sellers, they were in control. They took control of the direction of market at that particular time, maybe in a hourly or in a 4 hour or anything else, a minute or anything else, whenever time frame you set for this candle. Now so now the message is, sellers, they were in and they took control of the direction of the market. So now what we'll wait to and wanted to see in the next move is the next candle may keep on pushing down. So if it keep on pushing down, we may take a trade now, or sometimes it may pull back up to 50%. We must wait it until it crosses up to 50%, so we can take a trade now. So if it crosses beyond this 50%, now that will be a different thing. That will be a different message now. That will be a different information. So what we need to wait is to see it to see it moving around the 50%. So it may move up to 50% area, then push down and crosses maybe below this area. It is not necessary to close around the 50 area, but price will move around the 50% area and then goes back down, down and down. So how to trade this? How you are going to trade this? And the area, the specific area where you will take a trade once you see a shooting star. Now mainly a shooting star is traded when we have a long-term downtrend, then a price corrected shortly or it pulled back, then at this area it forms a shooting star. Now when it forms a shooting star at this short-term uptrend of a long-term downtrend, so we'll take a sell trade in continuation of this trend. That's how we are going to trade this. This is what we call a pin bar. Now a second type of pin bar, a shooting star. Now we have already done with this, and this comes from those two. They come from a category of what we call the mono candlestick patterns. So mono candlestick patterns, there are still a lot. We still have other types of mono candlestick patterns, whereby we have a second category of mono candlestick patterns, where we have those who call the doji. Now we have those things we call them as doji candles. We have those doji candlestick pattern. Now doji candlestick pattern is a category of a mono. Now it is within the mono candlestick pattern, but it is different from pin bars. It is different from pin bars, although they form things like pins and other things, but they are not within the category of pin bar. They are just doji. And those doji, they are of two types. Well, the one we call it is a Dragonfly Doji. Now we have the first category, we have this we call the dragon. Now we have this we call the Dragonfly, a Dragonfly Doji. And then we have the second category, we call it as a Gravestone. We have this we call it as a Gravestone Doji. A Gravestone Doji. Now those are the dojis. We have two categories of doji candlestick patterns. So now let's remove this shooting star now and see a doji. Now this is the general doji. Now this is the general doji. It is not within the categories. It is not within those two categories. It is just a general doji. And mainly major information about doji is that price opens at a certain price. Our price opens at a certain area, so it may push up or push down in any way, but it comes to close at the same price or around the same price. So it may push up or down, and then it come to close around the same price. It's where we get those who call the doji. So doji things, it's all about indecision. In most cases, we call them as indecisions. Doji candles, they provide information about indecision of price. Buyers and sellers, when buyers and sellers, they are fighting. Buyers push it up, maybe buyers push price up, then sellers push it down. Up to the same price where buyers started. So it's where we get doji. So they may push down again beyond that area, then buyers come in again, and the major concept is price is going to close around the same opening price. So now after having those things, what we expect is we cannot trade this candle when it occurs. Just once it occurs in a price chart, we cannot trade it. We have to wait information from the next candle, even though this provides indecision information. But additionally, this may show reversal. If price was keeping on in a particular direction, in some cases dojis may show reversal of a particular trend. So now let's go deeper and see those who call the types of dojis. Let's go deeper and see those types of dojis. Now we have the first type of doji. This is known as a dragonfly doji. Now characteristics of a dragonfly doji. Now it has got a long lower tail. Now a tail is lower and it's very long. And then opening and crossing price, they are just above the long tail, and yes, just in the same area. Yes, that's what I mean. Opening price and the crossing price, they are above, in the same area above the long tail. Now what is the psychology behind this? Now the psychology is price opened at a certain area. Now price opened at the certain area, now this area here, then sellers come in, push the price down. Now sellers come in, pushing price down. After pushing it down, now buyers came in again, pushing it up until they reach the same opening price now, until they reach the opening price, and then the candle crossed. So now due to those movements, now what informations we get from this? The informations we get from this is buyers, they are taking control. Until this candle closes, it seems like buyers, they took control of the direction of the market. So we expect for the bullish momentum. So what we're supposed to do is to wait for the next candle. We have to wait for the next candle to see the formation of the next candle. So it may move as usual to 50% and then push up again. So if we have that type of formation, we can take a long trade. And what's useful? What's the useful dragonfly? A useful dragonfly is the one that occurs at a support area. We expect it to be seen around the support area, and it must be a support of a long-term uptrend whereby it corrected shortly. So at this area we have if we will have a doji around this area, so it will be in a good position to take a long trade. Now if it will be formed around this area, we'll be in a good position to take a long trade. So that's how you are going to use a doji, and specifically what's called a dragonfly doji. So I'm through with the first type of doji. So we are going to move to we are moving to the second now, to the second type of doji, where we have this we call the gravestone now. We have this to call it as a gravestone doji. Now a gravestone doji is just an inverse of a dragonfly. It's just an inverse of a dragonfly. Now what happens here is the same, but the difference is a tail is above. Now a tail is usually above now in what we call a gravestone. And what message we get from this is, now price opened at a certain area, and now buyers came in. Pushing it up. They pushed up to a certain area. Before candle has crossed, sellers come in again, pushing it down, and then it crossed around the same price as that where it opened. So if it crosses around this area, now the information we get here is sellers, they are in control now. Sellers, they are in control of the direction of the market. So we have to wait for the next candle. Now it may move around 50% of this doji, and then sellers may come in again, pushing it down. So we may take a trade, but mainly we will take a trade when a gravestone is formed around this area. We expect to have a long-term downtrend, then the price may push up, correcting up to a certain area. So if we will see a dragonfly around this area, we'll be in position to take a short trade. So that's how you are going to use doji candlestick, a doji candlestick. So I'm through with the mono now. I'm through with the mono candlestick patterns. So let's move to the die candlestick patterns now. I said we have 3 categories. So now we are going to the second category, the die candlestick patterns. So as I've said, in a die candlestick pattern is when we have 2 candles now we are reading just 2 candles from a price chart. Now a price chart may have thousands or hundreds of candles, but we just read 2 candles only. It's where we call it as a die candlestick pattern. So in a die candlestick pattern, we'll discuss things like Twizzers and Dojis, and now we'll have Twizzers. Now maybe I can write them there. Now we'll have Twizzers. Now we'll have things like Dojis, now like this, and then we'll have things like the engulfing. Now we'll discuss things from the engulfing. So we'll have 3 patterns discussed in a die. We'll have 3 patterns discussed in a die. So now in a die, I'm going straight to those patterns. Whereby the first pattern from those who call the what we call the die. Now the first pattern is what we call the railway track now. The railway track, those tweezers sometimes, those tweezers sometimes they are known as railway track. So those railway track, they are of two types. We can have those who call the tweezers bottom, and then we can have those who call the tweezers top. So now what we see here is what we call a tweezers top. So now a tweezers top is usually a bullish indicator. Now it usually indicates what we call the bearish momentum. So it is formed by a bullish candle which comes first, and then a bearish candle comes next. And usually we expect them to be of equal size. In most cases we expect them to have almost equal size, but sometimes they may vary a little bit in size, in terms of size of the body. They may vary a little bit, but in most cases we expect it to have an equal size between that bullish and bearish candle. Now, what message do we get from this? The message we get here is buyers, they were in control. They were pushing price up, but sellers came in and pushed it down. And usually after closing, now usually they must push down and close down. Now sometimes they may push down and then they get rejected to a certain level. So we don't need to see rejection. We don't need to see rejection in this type of candlestick pattern. So it must cross down like that. So now after closing there, the information that we get here sometimes is equal from what we call the pin bars. So some people, they interpret this as a synthetic pin bar. And it is in a category of what we call a bearish pin bar. It will be in a category of what we call a bearish pin bar or a shooting star. If you interpret those things clearly, you will find that buyers pushed up, then sellers came in. So combining those two things, you will get what we call the shooting star. So now this one, it is a bearish railway track, or a bearish tweezer, whereby it will be indicating the bearish momentum. So in order to trade this, we must have a long-term downtrend, so things may push up, correcting. So at this area we expect to see, now around this area we must see them like this. Then this one is bearish. Now this one is bearish. So after having them around this area of short-term uptrend, of a long-term downtrend, it's where we expect that price will resume to the downside. Now here we expect that price will resume to the downside. So that's how we are going to trade bearish railway pattern, or sometimes we call them as a tweezer. Now this is what we call a bearish tweezer. So now things goes on, we have other types of tweezer. Now we have the second type of tweezer. We have a second type of tweezer. Now it is a tweezer bottom. This was a tweezer top, and then we have now a tweezer bottom. And now a tweezer bottom, this is what we call a bullish tweezer. Now let's go straight to that thing. A bullish tweezer is something like this, whereby it is made up of a bearish candle which comes first, and then a bullish candle comes after. So now the information obtained from this, they are just the inverse of what was obtained in a bearish. Now they are just the inverse, whereby now sellers now come in. Sellers pushing down. Sellers were pushing down. So after pushing down, buyers come in the next candle. Now they push the price up. Around the same area where sellers started. So now until those two candles crosses, the direction of the market was under control of buyers. Now buyers were in control of the direction, so we expect the next candle to keep on pushing up, or it may move down up to 50% of these two candles and then keep on pushing up, and it's where we will take a trade. We will take a trade after having those informations, and it must be at this area. Now I'm indicating it again, but I'm sure you get me. From what I indicate usually all the time I talk about this. all the time I talk about this, so I'm sure you get me. So in order this to work as a bullish tweezer, in order for this to work as a bullish tweezer, it must be formed at an area within a long-term uptrend where price pushed a little bit down. So around this area we expect to see those tweezers there. Now tweezers like this, a bearish one, then bullish comes after, so we expect to keep on in continuation with this previous trend. So we keep on buying in continuation of this previous trend. So that's how we are going to use those who call the bullish railway pattern or the bullish railway track. Sometimes they are known as bullish railway track, or anyway sometimes they call it as bullish tweezers. So in any way that you may call those things, but you must have an idea about how they work. That's a very important thing, how they work. That's very important information. So after this we have those who call the tweezers. Now I'm through with the tweezers. Now I'm going to those who call I'm going to other categories. We have those who call the soldier. Now we have those who call the soldier. So we have those who call the soldiers. Now soldiers, they are of two categories. We have the one white soldier, and then we have the black crow. Now I presented this as soldiers, but we have a soldier and then we have a crow. We have two types. We have a soldier and a crow. We have a one white soldier. Now I can write those information there. We have a one now, a one white soldier, and then we have a one black crow. Now those are category. Now these are categories within die. They are categories within die candlestick pattern. We interpret two candles at a time. Just two candles, we read them at a time. So now we have those two. Yes, so we have those two categories. Now let's start with the first category now. Now we have the first category. This is known as a black crow. Now the first category here is what to call a black crow, a one black crow. Now in a one black crow we expect a bullish candle now starts now or comes first, then a bearish candle comes after, and it opens now. It opens lower to the closing price of the bullish candle. It must be like that. So in other words, we can interpret that here is like there's a gap. It seems like there's a gap between those two candles. There will be a gap. If you know those gaps in the price charts, now those gaps may be formed in areas like this. So price closed here, but instead of opening around the same area, it has opened a little bit lower and then started pushing down. So now, and it crosses beyond the opening price of the bullish candle. So now what message do we get from this? A message that we get from this is that sellers come in with a very great power, because once this was crossed, now sellers, they didn't wait to open at that price. They pushed it strongly and then opened at a very low price, and then kept on pushing down and crossed beyond the opening of the previous candle. So now when this occurs, usually it gives us bearish momentum. Now the message that we get from this is sellers, they are in control. Sellers, they are taking control of price. So if sellers, they are taking control of price, so we may look on the next candles here, at least a single next candle now, here. Don't take trade immediately after having those two candles here. So you have to wait for the next candle, where the next candle may push to 50% or anything else, or sometimes may keep on pushing down, So once you see this happening in the market, so you can take a sell trade or a short trade. You can take a short trade. So as usual, this one must occur at a short-term uptrend of a long-term downtrend. I think now you know. When I'm explaining about those short-term, in a long-term, or anything else. I'm sure now you are aware of that. So that is all about the the black crow. Now this is what we call a black crow. Now remember, this is what we call a black crow. So now let's see the one white soldier. The one white soldier, something like this. This is what we call the one white soldier. We're talking about this, the one white soldier. So now, usually, this pattern is formed of two candles. That's why it comes from the die candlestick patterns, whereby it has got the first, now a bearish candle, which comes first, and then we have a bullish candle. Now, bearish candle opened there. Then sellers push down up to a certain area. So after closing, buyers come in with a very great power and push the price strongly, leaving a gap at this area. They leave something like a gap in this area instead of opening around this area, so they opening little bit higher. So they keep on pushing up beyond the opening price of the previous candle. So until this candle closes, when you see the relationship between those two candles, you'll find that buyers, they are in control now. Buyers, they are in control. So if buyers are in control, we may look for the next candle. We expect it may push down a little bit and then keep on moving up, pushing up, and therefore this pattern usually indicates a bullish momentum. This usually indicates a bullish momentum, and it must occur at a short-term downtrend of a long-term uptrend. Now that's where we can trade this. We must see a dominating trend to be bullish, and then there is just a short-term pullback. So after that pullback, once this has been formed, so we can take a trade in order to keep on trading, buying. So that's how we're going to do those things. So we are through with those who call the soldiers and the crow. We are through with what we call the soldiers and the crow. So the last pattern in a die is the engulfing now. The last pattern in a die is what we call the engulfing pattern. Now that is the last category in a die candlestick pattern. Whereby those engulfing, they are of two categories. We have the bullish engulfing now. We have the bullish engulfing. Then we have the bearish engulfing. Now those are the two categories. They are very simple. Engulfing patterns, they are very simple, and I think everyone knows. So now a bullish engulfing, it's when a bullish candle engulf a previous candle there, and a previous candle mostly must be bearish. And then in a bearish engulfing, we expect a bearish candle engulf a bullish candle. So a bullish candle must come first, and then a bearish come later. So now how they look like, let's go. So now we have this one, the first category, a bullish engulfing. We have the first category, a bullish engulfing. So here, this is a bullish candle, and the first one is bearish candle. So bearish candle is smaller than the next candle. So this next candle has engulfed this small candle. So the psychology behind this is buyers, they are in control. That's all. The psychology is buyers, they are in control. Now, when this one was getting completed, it closes at a certain area. Then, now sellers kept on strongly pushing this down. Now, the strong now it seems like they left a gap here. We can interpret this as a gap because instead of opening around this area, it opened strongly down. So sellers, they had power pushing it down. But buyers later come in, pushing it up, and then they pushed up beyond the opening price. So in general, buyers, they are in control of the direction of the market. So if buyers are in control until the time when this candle was closing, so we expect buyers, they will keep on pushing up. So next candle here can keep on pushing up, or it may come down a little bit lower to certain percent there. Usually we expect 50%. Usually we look at 50%. So it may come up to 50% and then keep on pushing up. So once you see this, and always it must be at a short-term downtrend of a long-term uptrend. So once you see this at that area, you can take a long trade. Usually this indicates a bullish momentum. Usually you can take a long trade. So I'm through with this. It's very easy. Now we have this one, the next one, the bearish engulfing. Now in a bearish engulfing, we expect that we have a bullish candle that comes first. So we expect that a trend was now a long a long-term trend or a greater trend was up. So after having that long-term trend up, price corrected. So after now around that correction, so we expect to see this formation. So if we see this formation around the correction point, where now we're talking about the bearish now, we expect that a trend was down. Please, now I was interpreting this differently. Now let me repeat this. So we expect a long-term trend was down, so prices started to push up as a correction now. So prices started to push up as correction of that long-term trend. So after correction to a certain degrees or to a certain percent, we expect that this will be formed. So when this is formed at a correction area whereby it was correcting a long-term downtrend, so we will take a short trade in continuation of that greater trend. Will take a short trade in continuation of the downtrend. So we are through with the bull now. We are through with the die now. We are through with the die candlestick patterns. So we are moving to the last category. We are moving to the last category, whereby the last category is about the tri-candlestick patterns. We have those who call them as the tri-candlestick patterns. The tri. Now tri is when we interpret 3 candles. Now in a tri-candlestick pattern is when we interpret 3 candles in a price chart. A price chart may have hundreds or thousands of candles, but our concentration is on 3 candles. So when we concentrate on 3 candles, is what we call the tri-candlestick pattern. Now in a tri-candlestick pattern we have 2 categories. We will discuss only 2 major categories of the tri. Now the first one, we have this we call a morning star. We have this we call it as a morning star. A morning star. And then the second category, we have this what we call an evening star. We have this we call it as an evening star. Now evening star and morning star, those are categories of tri-candlestick pattern. Now let's go to those tri. Now we have this is known as a morning star. This is known as a morning star. Now a morning star morphologically, now it's made up of a bearish candle that comes first. Now it is followed by the next small candle, which can be bearish or bullish. Now this middle candle can be of any type, can be bullish or bearish. So after having this of any type, we expect the next candle now will be bullish, which has got a size almost similar to the first candle. It must have a size almost similar. It's not necessary to be of the same size, but almost similar. So now once we have those 3 candles arranged in the same area, at the same area, what message do we get from this is sellers, they were taking control now. They were pushing price down. Sellers were pushing price down. So when they were pushing it down, now they reached a point when they were like in indecision, something like that. It's like an indecision here in the middle there. It's like an indecision. They failed to push it in a greater distance. Now they failed to push it in a greater distance, so they were like in indecision. And then after having that, after that indecision, now buyers came in with a great power. Now buyers come in with a greater force, so they push the price higher and higher, so they close the to a certain very higher price. So until those 3 candles complete, until completion of those 3 candles, the message we get here is buyers, they are in control now. Buyers, they are in control. They are in control of the direction of price. So if buyers, they are in control, we'll wait for the next candle. We'll wait for the next candle to close. So the next candle may close to 50% or may close upward now, showing that buyers, they are still in control. So after that next candle, we can take a trade, because sometimes you can have this formation, but the next candle may close strongly lower. Sometimes those things happen. The next candle may close strongly lower. So we have to wait for the next candle here to close either around the 50% or to close above this formation. So now this one, a morning star, usually a morning star that we are going to trade. Now remember this, a morning star that we are going to trade, it must be at a short-term downtrend of a long-term uptrend. As usual, that's my principle. The principle, now this is the principle of using candlestick patterns. This is the principle of using candlestick patterns. You must have a long-term uptrend, now price pushing up, then it corrected down a little bit. So we must have that formation around this area. We must have this formation around this area. So what we are going to do is we wait for the next candle, then we take a trade in continuation of this trend. So once you have this formation at an area which is different from this, don't trade, because it will work differently. A morning star that works is the one that is formed around this area, a short-term downtrend of a long-term uptrend. That is all. So I'm through with the morning star. Let me complete this session. Let me complete our today's session by looking on an evening star. Let me complete our today's session by looking on an evening star. Now, an evening star is something like this. An evening star, something like this. It has got a bullish candle. It's not necessary to be very big like this. No, it may be of the same size like the bearish candle here, but sometimes it may be bigger or maybe smaller, but we need to interpret those three candles there. So now it has got a bullish candle. The next small candle can be bullish or bearish as usual. Then the last candle should be bearish. Now the last candle should be bearish. So now what we expect here is, now what was taking place now? What was taking place here was buyers, they were in control now. They were pushing price up. Buyers, they were pushing up. So it reached a point when buyers and sellers, they were like fighting. Pushing up and down. And so no one pushed the price further. In this candle. So in the next candle, now sellers came in and took control. Now sellers took control of the direction of the price. So they pushed it down, push down. So it crosses down, sometimes maybe beyond this or in anywhere around. But what we need to see is this type of formation. So once we have this, it indicates that sellers, they are in control. Now this indicates that sellers, they are in control. In control of the direction of the market. So we expect for the next candle and mainly to close either at 50% or to close just lower, may keep on pushing down, so it may close lower than those three candles. So that will be an indication of the bearish momentum. Now that will be an indication of the bearish momentum. So we'll keep on taking trades. Now we'll keep on taking trades, selling, because we'll be trading an evening star when it is formed at a short-term uptrend of a long-term downtrend. As usual, that's the principle. Now we must have a downtrend. So buyers came up, now push it up a little bit. Then we will have that formation. A bullish candle comes here. Then we have this, the spinning thing. Then the sellers come in. Push it down. So once we have this formation, this will indicate that we may continue to sell because the previous trend was already down. So we can keep on pushing down, selling. So that's how things goes. And this was my today's idea. And it's just from those who call the free contents. Anyone have access to this. Those are the free contents that everyone can have access. But we expect to have seminars now. We have planned for seminars. Remember that. We have planned for seminars. Now we had this curriculum and trading fees. We have this curriculum and trading fees where most of traders who need training individually. For those who need training individually, we have been using this and we are using it till now. So the problem is most of people, they don't afford those fees. They don't afford. Most of them, they request for sessions, but once they have presented with the fee, they run away, or they fail to pay. Very few, they pay those fees. So we have planned to have seminars, and this is just in Tanzania, in various regions in Tanzania. We'll conduct in various regions in Tanzania, including Dar es Salaam. Then we'll have Zanzibar. We'll have seminar in Dodoma. We'll have seminars in Mwanza, and also we'll have seminars in Arusha. So we'll be doing those things in Arusha. We'll do seminars, and those seminars will involve those similar training, like those we provide in those paid sessions, but the price for seminars would be just lower, not like this. It will be lower, not like this. You'll get same things like how those who pay for who pay for sessions they get, but you'll get it for just a lower price. So that's what we're going to do, and it has been planned, or it has been scheduled on 2022. Early on 2022, we are going to do that. On very beginning of 2022, we are going to offer those seminars in those mentioned regions, but we can go to other regions. I forgot in Morogoro also. We'll be in Morogoro. Remember, we'll conduct seminars in Morogoro. So that's what we are going to do. So thank you for your time. Thank you for your time. And remember, here is Awesome Forex. So make sure that you follow those key sites there. Also make sure that you subscribe to this channel. Make sure that you share those contents. So now those are the basic things that you have to do. So thank you for your time, and welcome again to Awesome Forex.